Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today I'm going to be analyzing Akamai technology stock, ticker AKAM. This one came in by request down in the comment section of one of my other videos. If you have a request you'd like me to make a video on the channel, just put it down in the comments. I will get it on the whiteboard behind me, the ticker that is, and eventually I'll make a video. If it's a stock that's in the S&P 500, I post those on YouTube for free. The rest I post over on Patreon at the $5 a month tier level. And if you join over there, you can get a big discount to the full Cyclical Investors Club service if you ever decide to join that over on Seeking Alpha. I'll have all those links down in the description. I also have a link for a 25% off Fast Graphs, which is what I'm going to be using. One of the tools I'm going to be using here in this video to analyze Akamai, and it sets up pretty well for this type of earnings analysis. So Fast Graphs can come in pretty handy for that. As always, this is not individual investing advice. This is just how I analyze stocks. So let's get into Akamai. So the first thing that I always look at is the historical earnings cyclicality. So that's going to be kind of shown as this dark green area here on the Fast Graph. And what I'm looking for are historical drawdowns of earnings. So we have one here in 2010, a mild one here in 2017. If I shorten this, and then one in 2022, it looks like, or maybe 22. If I shorten this, I can see the individual years. So we have a 14% decline in earnings growth, or decline in earnings in 2010, and then a 3% decline here. And a couple years ago, we have, let me shorten this a little bit more. We have a 6% decline. So what I'm looking for is to see if they have really cyclical earnings that go up and down like really deeply. Usually 50% or more. If I notice earnings are dipping more than that, I use a different strategy, a different analysis that doesn't focus on predicting and projecting earnings, because they can fluctuate a lot. If you try to use a standard valuation approach with earnings and earnings growth for a cyclical business like that, often it can send exactly the wrong signals. They will look very cheap during an up cycle, and they will look very expensive during a down cycle. And the opposite is usually true if you have a high quality one that bounces back. That's with cyclicals, but this one isn't cyclical, so we don't need to do any of that. So I'm gonna shorten this time frame to 2015 through this year's earnings. So that's a 10-year time period. And usually what I do is I look at history, I look at the trends, and I try to kind of extrapolate that out after I control for some other things that might have gone into whatever the earnings have done. So what I want to know is what the earnings growth rate is, and then I want to know kind of what the valuation they're trading at right now is, and then I project that out 10 years into the future, and that gives me an idea what kind of returns I can expect if history kind of repeats, basically, or continues. So I like to have one recession. Technically, we do have this recession from the pandemic. But we don't really have like a real recession in this data. So it's probably going to be a little on the optimistic side. But I am going to share just a normal valuation buy price and a recession buy price where I go back to 2008 and look and see what happened there with the stock. And so we can get an idea, okay, if you think there's going to be a recession in the next couple of years, you can use that recession buy price. If you're not too worried about it yet, you could just use the standard buy price. So first thing we want to do is figure out earnings growth. So on the Fast Graph, if you frame it up right, which I've done here with your time period that you care about, it does tell you the earnings growth rate here. That measures from this earnings date to the, I think they use the forward one, whatever you put it in the Fast Graph, like wherever you end it at. So I could end it in 25, and then you can see that earnings growth changed a little bit, but I'm going to end it in 24. So Fast Graphs, you just draw a straight line through that period on earnings per share, you get 9.79% earnings growth. I like to control for two additional things here. One are earnings growth decline. So there's these very small ones here. They aren't going to make much of a difference, but it would affect the earnings growth rate slightly. The other thing I control for are stock buybacks. So they bought back about 15% of the shares. So when you buy back shares and you're using earnings per share, it will inflate the earnings per share over time because there's fewer shares. So even though earnings might not be rising, like net income might not be rising fast or at a certain rate, the earnings per share can potentially rise faster than that if the shares get reduced over time. I really care more about just the pure number. In my mind, I think of it as like owner's earnings. So I want to have the ability to take those excess earnings they're using to buy back shares, and if I own the business, I could just keep them for myself. So that's more how I think about it. So I like to control for that, and it just usually makes for a more conservative valuation process too. It can make a big difference on some stocks to buy back a ton of shares, like Home Depot. There's a couple others that are bought back like half the company, and it can really smooth out their earnings per share, make them look more stable. You can see why management does it. And as long as the business is growing at a good rate, like, I don't know, 10% or more a year, then usually buybacks do kind of make sense, even if they're just kind of programmed and automatic. And that's not ideal. You really want management to be buying back shares when the shares are cheap and then to stop it when they're expensive, but they don't tend to do that. They tend to just buy it back all the time, and then they can mask their stock compensation a little bit more and smooth their earnings per share more, and they can cut the buybacks if they need the money at some point. I mean, you can definitely see why managements do this, but I like to control for it so I can try to figure out what the real earnings growth rate is if they weren't doing those things. It's just a personal preference of mine. So when I do that, I get a little more conservative earnings growth rate. I get an 8.78 earnings growth rate estimate. So that's what I'm going to assume earnings grow over time. And then the current PE ratio, what do we have going on here? Okay. I also control for debt when I do my valuation a little bit. And so the way I do it is I take the however much higher or lower. Sometimes if you have a cash like Google or somebody that has cash, the total enterprise value can be lower than the market cap. But what I do is I just look and see how much higher the total enterprise value is than the market cap. This case, I think it's about like 15% or so. And then, or the last time I updated it, it might be slightly different if you do the math today, but it moves a little bit when the stock price moves. So let me go actually see what I've done. 18%. So what I do is I increase the stock price. This is the real stock price by 18%. So like if you were going to buy this business, you would pay off the debt as well as the price of the stock, basically. And so that's what the idea behind this is. And so that gives them, again, a more conservative valuation, but sometimes more realistic, because some of these highly indebted businesses can trade at lower PEs, which makes them look more attractive than they really are. This usually can, in a very quick way, kind of make adjustment for that. So I'm going to treat the stock as if it's trading at $115 per share for valuation purposes, and that produces an earnings yield of 5.5%. So the earnings yield is the PE ratio inverted. So without that, let me move my head just slightly here. Yeah, so this is the PE ratio before the debt adjustment is 15. So it would be a little bit higher. It'd be 18% higher or whatever. And then when you invert that and put earnings over price, you get 5.5% for the earnings yield. So the way I like to think about this is if I bought Akamai's whole business for $100 and their debt, I would earn $5.50 a year, and that would grow at 8.78%, I think is what I had. So I pulled the first year's growth forwards. That would be $5.98 I would earn on my $100 the first year. And what I want to know is, after 10 years, how much money would I earn if I bought this business from the earnings? How much would I earn from the collected earnings? And you would collect about $190 after 10 years using this method. So what I do is I convert this into a CAGR. So if you use like a CAGR calculator on like MoneyChimp or someplace like that, you put in $100 as your starting, 189.94 as your ending, and then 10 years as the time frame, and it should spit out a CAGR, a compounded annual growth rate, of around 6.63%. So, and this is pretty good. I mean, this is definitely cheaper than the average stock in the market. And it's even a little just off, like I consider like 6.5 to be about fair value, give or take. So it's around fair value, I would say here, but definitely cheaper than most of the stocks in the stock market right now. 8% is usually my buy threshold here. So the lower the price goes, the higher this goes, and the more attractive the future returns from the earnings will be. Let's see. So let's get back here real quick. Now what I want to do, well, let me give you the buy price on just using that method. So in order to cross that 8% threshold, about $75.50 is what I'd be looking at on the stock price. And at that level, assuming no recession in the near term, would be a buy, right, for Akamai. Now, if you do think there might be a recession, the buy price is going to be lower, $51.28, which is about 47% lower than where it trades now. I based that on the 2008 recession, which was a bad recession. So if you think that maybe there's just going to be a weakening, or maybe just not a really bad recession, just kind of a bad recession, then maybe you don't go all the way down to that $51, but somewhere in between like 75 and 55 or so that's going to be the rough area you would want to start accumulating probably. If you're really trying to get it pretty close to a recession bottom, or you just want a more margin of safety closer to that 51.28 number is what you'd be looking at. So the way that I do that is I go back to 2008. I look at how far the stock price fell relative to their peak earnings going into 2008, which 2007 and 2008 earnings are about the same. Like their earnings really didn't fall very much during that time when we see here. But they did have an 80 PE going in, and they bottomed at an 8 PE. So if you kind of think about that, of course, earnings did rise 100%. So if you look at the stock price did fall over 80%. So that tells you the market it has a history at least of punishing the stock quite a bit. And then in 2011, we have a similar thing. The stock price nearly recovered its pre-recession high, and then it sold off again over 60%, probably closer to like 65%. Let's look at some of these other drawdowns too. This is actually kind of interesting. Let's go to the one most recently here from 2022 down into 2023. That's a 40% decline, maybe more like a 50%. Let's take a peek. Yeah, like 40%. And there was no recession. So that's worth looking at because it lets you, because 2008 was so long ago, you can look at this more recent one and just kind of use your head a little bit, use your imagination a little bit, and think, okay, there wasn't a recession in 2022, but the stock still fell over 40%. In 2011, it fell 65%, and in 2008, it fell 80%. So the stock price has a history of falling a lot more than earnings do. And that can, let's see here, we'll pick another 2015 to 2016. That was kind of a little, so it was down about 50% during that time. So it has a very consistent, I'm just going to look here and see, I'm looking at the peak and trough prices here to just kind of, so we had $78 as the peak and then 44 is the trough, right? So pretty big declines. and even though earnings were pretty steady. When I have a stock like that, it can be very good because the market can give you opportunities that are for high returns. So let's say you didn't buy it in 2008 or whatever, the overall market kind of recovered, but you got this other opportunity in 2011. I mean, if you just bought it down 65% off its highs or whatever, and then let's say you held till pre-pandemic, you would have got a 20% CAGR over that, let's see, 9 years, 8 or 9 years. So that's what makes this potentially like attractive to me, are these huge potential returns when the market overreacts. Overall, they have steady earnings. I mean, earnings didn't grow 20% on average that time, but when you buy it at a cheap enough price, then you can get those kind of returns. And it looks like, let's zoom in here. I mean, we had potentially one of those mini opportunities. So yeah, it rose about 80% off that bottom in 2023. I forgot how much I said this went down, over 40%. So it's not quite deep enough like to be super attractive for me because I like to get a margin of safety. But I do think that other investors, are usually more willing to step in earlier than I am. I do think this is also one where I haven't been using the mean reversion very much lately function here on FastGraph, which is the normal PE. But this is one, if you want to trade a little bit more actively than I do, and if you're willing to accept a little bit lower returns, and if there's a recession, if you understand that it could still fall pretty deeply, then you could play this for a mean reversion here. So right now it's at like 15 PE. This blue number, it usually trades at like a 20.76. So if it reverts to there, that's like a 35% gain. And you could say, hey, things are looking okay for these guys. They don't look like they're bouncing back actually right now very much, but I think analysts expect them to. I did update these earnings and they had fallen, the expectations had fallen quite a bit. I just updated it right before I did this. And I want to say this was like 670 something or 660 something. So that would have been just 3 or 4 months ago. Analysts were expecting better earnings. And so the expectations have come down. But you can look in 2025, 2026, analysts are expecting the kind of growth that basically I projected, especially if they just kind of beat slightly. So, you can go out a couple years. I did that one like 1 year, but if you go and say, in 18 months, you could potentially get like a 40% return if it reverts to the mean. I'm not making those type of mean reversion investments just yet, since interest rates are still pretty high and there's all kinds of other stuff going on. I just kind of holding my cash and kind of seeing if I can get some good deals, like some really good deals. But I could definitely see an investor who, if they like this business and they're just looking for like a decent valuation, or they want to be more fully invested and they're trying to find good relative values. This looks like a pretty good relative value to most of the stocks in the S&P 500 right now. And you're probably not going to lose too much over the next 5 years, even if things are kind of not great. And, if you wanted to trade it a little bit and try to get a 30 or 40% return over the next year or two, I think it's totally doable. I mean, they've done it many times in the past, so it's not a bad bet in that respect. Okay, if you found this useful, hit the subscribe button, hit the like button. If you have a request, put it down in the comments section, and I'll see everybody later. Bye.